Most people have no idea what just shifted beneath their feet. And I'm not saying that to scare you. I'm saying it because right now, a lot of investors are reacting emotionally. And emotion in markets is expensive. It's expensive because it collapses your time horizon. It makes you make permanent decisions based on temporary discomfort. And if you've been staring at the price, refreshing your portfolio, watching red numbers stack up, and wondering whether you made a catastrophic mistake, I want you to hear this clearly. Price is what your eyes lock onto. Structure is what actually moves the cycle. The price is loud. Structure is quiet. The price is the distraction. Structure is the story. And if you don't learn to read that story, ownership, liquidity, leverage, and institutional positioning, this is exactly the kind of environment where portfolios break. Not because of one dramatic headline event, not because of some black swan that makes the news, but because of slow psychological erosion, the kind that convinces you to sell at the exact moment the market is transferring assets from emotional sellers to disciplined buyers. I've watched multiple cycles. I've watched euphoria flip into despair, and despair turn into generational opportunity. This moment has a different texture. Not necessarily worse, not necessarily better, different, and different requires a different kind of analysis. Before we go further, I need to set the frame professionally. This is not financial advice. I'm not telling you to buy, sell, or hold. I don't know your income, your expenses, your risk tolerance, your time horizon, your tax situation, or your personal circumstances. Bitcoin is volatile. You can lose money, and you can lose a lot of money. My goal here is not to give you instructions. My goal is to explain risk, structure, and the data so you can think independently and make your own decisions with your eyes open. Now let's talk about where we actually are, because the point is not to pretend drawdowns don't matter. They do. A deep drawdown changes behavior. It changes narratives. It changes liquidity. And it creates the emotional conditions where most investors do the wrong thing for the right emotional reasons. Bitcoin has been trading in a depressed range relative to prior highs, with the market digesting a major repricing. In plain English, we've been through a real drawdown, not a cute dip. And across the rest of crypto, Ethereum, and large cap altcoins, the drawdown has been even more aggressive at times. That's not a moral judgment. It's just volatility math plus risk appetite rolling over. But here's the key question you should be asking. And it's not, when does price go back up? The question is, does this repricing reflect a fundamental break in the value proposition of Bitcoin, or does it reflect a liquidity and positioning reset? Because those are two very different worlds. If the fundamentals are broken, you should reassess everything. If it's a liquidity and positioning reset, then the pain you're feeling is the cost of admission for an asset that moves like Bitcoin moves. And in that second world, the biggest danger isn't the drawdown itself. The biggest danger is what you do during the drawdown. So let's separate two concepts, price and structure. Price is the number you see. Price is where your emotions attach. Price is where narratives form. Price is where the media lives. Structure is the underlying architecture of the market. Who owns the asset? How concentrated ownership is? What those owners' time horizons look like? Whether their capital is sticky or fragile? Whether they are using leverage? Where liquidity is thin? Where forced selling can cascade? Where real demand sits? Where supply is locked up? Structure determines where price eventually goes. Price in the short term is often noise layered on top of structure. So what has changed structurally? First, ownership has been migrating. And this isn't a vague institutions are coming meme from 2017. This is measurable. Data compiled by Bitcoin treasuries based on public company filings, treasury disclosures, and verifiable reports shows that public companies hold a meaningful and growing amount of Bitcoin on their balance sheets. These aren't retail traders with a Robinhood account. These are corporate treasury decisions, approved through governance, often disclosed publicly, and typically framed as multi-year strategic positioning. At the same time, exchange-traded products have become a major channel of exposure. If you look at reported holdings for Bitcoin ETPs and spot products, the aggregate amount of Bitcoin held in these vehicles has become large enough that it changes the supply and demand math at the margin. This matters because the marginal buyer sets price, and when a new channel captures steady demand, it affects the market's microstructure even if the macro tape looks ugly. Now, I want to be careful with definitions because credibility matters. When people say institutions hold X%, it's easy to double count. ETF holdings are custodied somewhere. Custodians may also be classified as institutional. Exchange wallets can reflect customer holdings. Some categories overlap, so measured language is important. Here's the honest version. Multiple datasets, public treasury reports, ETP reporting, and on-chain analytics show that a meaningful portion of Bitcoin supply is now held by entities that behave differently than typical retail. The exact percentage depends on how you define categories and whether you net out overlap, but the direction is unambiguous. Ownership is shifting toward longer horizon capital, and that shift matters because behavior is the whole game. Retail capital is often fragile, not because retail is dumb, but because retail is human. People have bills, people have life events, people have anxiety thresholds, people use too much leverage, people chase narratives at the top and look for reasons to quit at the bottom. Institutional and corporate capital can also be forced sellers. Don't misunderstand me. Institutions don't never sell. They often sell mechanically, rebalancing mandates, risk limits, redemptions, VAR shocks, committee decisions. In fact, mechanical selling can be more ruthless than emotional selling, but the key difference is that a large portion of institutional type exposure, especially corporate treasury allocations and some long duration allocators, is not reacting to a 10% move the way an overleveraged retail participant does. They're not checking the chart at 2 a.m., they're executing a policy. That doesn't guarantee upside, it doesn't guarantee stability, but it changes the character of the market. Second structural shift, liquidity dynamics have changed. And this is where most retail investors are watching the wrong indicators. When markets are frothy, leverage builds quietly. Open interest rises, funding gets euphoric, basis trades get crowded. People assume liquidity is deep because price is going up. Then when a move goes against the crowd, the market finds out how thin liquidity really is. During major sell-offs, a lot of what you're seeing is not a change of mind. It's positions getting closed because they have to be closed. That's forced deleveraging, and you can track this. You can look at futures open interest across major venues. You can watch how it contracts after liquidation events. You can monitor funding rates and basis. You can compare implied volatility in options markets with realized volatility in spot. You can track spot volumes and order book depth, not just the price. When open interest collapses and funding normalizes, that usually means leverage is being flushed out of the system. And paradoxically, that can be stabilizing over time because the dry tinder is being removed. Think of leverage like a dry forest. When it's dry and crowded, a small spark turns into a wildfire. When the forest is already burned, the next spark doesn't spread the same way. The damage is already done. The leverage is already gone. Now, does that mean price immediately goes up after deleveraging? No. It means the conditions for violent cascading liquidations may be reduced. It means the market may transition from forced selling to two-sided trade, where real buyers and sellers set price rather than liquidation engines. That transition matters. Third structural shift, sentiment and participation are diverging from adoption. This is subtle, and it's easy to miss because the loudest voices are always the most emotional. When price is down, mainstream narratives always get dramatic. Bitcoin is dead again. This cycle is different in the worst way. The experiment failed. We've seen this movie a dozen times. But if you look at institutional surveys and adoption indicators, a different story often appears underneath the noise. For example, wealth management and family office surveys from major financial institutions have repeatedly shown rising engagement with crypto, either already invested or actively exploring. These are not TikTok traders. These are organizations with investment committees and due diligence processes. When their adoption rises during a period of drawdown, that tells you something. Interest isn't purely a function of euphoria, it's becoming structural. Is that bullish tomorrow? Not necessarily, but it supports the idea that what you're experiencing is not a collapse in relevance, it's a repricing inside a broader adoption trend. Now let's zoom out and connect structure to psychology, because this is where most returns are actually won or lost. There's a concept in behavioral finance called loss aversion. In simple terms, people feel losses roughly twice as strongly as they feel gains. A 20% gain feels good. A 20% loss feels like a punch to the stomach. And because of that asymmetry, investors don't behave rationally under stress. When you're down, you don't just want to reduce risk. You want to stop the pain. You want relief. And that's where the market gets you. Because fear compresses time. A 5-year thesis becomes a 5-day panic. You start looking for information that justifies selling. You start letting your feed, your group chat, the loudest bearish account on social media, and the most dramatic headline rewrite your long-term plan in real time. And here's the part that stings. When you sell to stop the pain, you often sell into maximum liquidity demand from stronger hands. This isn't a conspiracy. It's market mechanics. Markets transfer assets from weak hands to strong hands, from short-time horizons to long-time horizons, from emotional participants to disciplined participants. That's not a moral statement. That's a description of what happens when volatility meets human psychology. So the real question is not whether you are smart or dumb. The real question is whether your process can survive your emotions. Institutions have processes. Retail usually doesn't, but you can build one. And building one is how you stop being the liquidity for somebody else's long-term strategy. Now let's talk about the macro backdrop, because Bitcoin doesn't trade in isolation. It trades inside a global capital allocation system, and that system is shaped by interest rates, liquidity conditions, dollar strength, risk appetite, and competition from other high-growth narratives. The Federal Reserve still matters. Liquidity still matters. Real yields still matter. When risk-free yields are high, capital has alternatives. When you can earn a meaningful yield in short-duration treasuries or money market funds with minimal volatility, the hurdle rate for speculative or volatile assets rises. That doesn't kill Bitcoin. It changes the marginal buyer's calculus. This is why you'll often see risk assets struggle when policy is restrictive and perform when policy becomes accommodative or when markets anticipate accommodation. But the relationship is not instant and not linear. There are lags. There are second-order effects, there's positioning, there's reflexivity, there's the fact that markets price expectations before they price reality. So when people say rate cuts are coming, therefore Bitcoin goes up, that's incomplete. The more accurate statement is, if liquidity expectations shift sustainably and capital rotates back into risk, Bitcoin historically has responded, but timing and magnitude vary, and the path is never clean. And right now, Bitcoin is also competing with other massive narratives for capital. One of the biggest is AI infrastructure. Hundreds of billions of dollars have been pouring into AI-related capex, chips, data centers, energy infrastructure, cloud build-outs. That money comes from somewhere. Portfolio allocations are not infinite. When AI is the dominant magnet, some flows that might have gone into Bitcoin go elsewhere in the short term. Does that mean Bitcoin is structurally weaker long term? Not necessarily. In fact, you can make an argument that AI's energy demands, capex intensity, and potential inflationary second-order effects could eventually strengthen the case for scarce assets. But in the present tense, it can absolutely compete for risk, capital, and attention. So what does all this mean for price path? It means you should stop thinking in one-track predictions and start thinking in conditional scenarios. Not it will go up, not it will crash, but if this condition persists, the probability of that outcome increases. That's how grown-up analysis sounds. So let's lay out 3 scenarios for the next 12 to 18 months, with clear conditions and plausible timing, without pretending we can see the future. Scenario 1, the liquidity expansion scenario. If inflation cools meaningfully, if financial conditions loosen, and if the Fed signals a clear pivot or markets gain conviction that policy is moving toward accommodation, risk appetite can come back. Historically, when liquidity expectations shift, Bitcoin often responds with a lag, frequently in a 3 to 6 month window, though it can be faster or slower depending on positioning and sentiment. In that environment, if ETF flows stabilize or resume net positive, if corporate treasury demand remains steady, and if supply remains tight relative to incremental demand, the probability of a strong upside move increases. That doesn't mean straight line up. Bitcoin tends to move like a staircase up and an elevator down, slow grinds upward punctuated by sharp corrections. But the regime would favor recovery and potentially a retest of prior highs over time. Scenario 2, the range-bound grind. If inflation stays sticky, if rates remain elevated longer than markets want, and if macro data stays mixed, Bitcoin can chop. It can trade in a wide range for a long time. Rallies get sold into. Dips find buyers at key zones. Everyone gets bored. Everyone gets impatient. Everyone starts looking for something else. This scenario is psychologically brutal because it doesn't give you closure. It doesn't give you the cathartic capitulation of a crash, and it doesn't give you the dopamine of a moonshot. It just slowly drains attention. But structurally, this scenario can still be constructive because accumulation can continue under the surface while weaker hands exit through boredom rather than panic. Scenario 3, the deeper risk-off drawdown. If recession risk rises, if credit stress appears, if equities roll over hard, or if we get an external shock that hits global risk appetite, Bitcoin can absolutely drop further. In a true risk-off event, correlations go to 1, liquidity disappears, and sell what you can replaces sell what you want. In that environment, key support zones can break, and the market can search for levels that feel unthinkable today. That's not fear-mongering. That's just acknowledging that Bitcoin is a high-volatility asset that has historically experienced large drawdowns, even within longer-term uptrends. And paradoxically, those moments have often been where long-term expected returns are the highest, if you have the liquidity, the time horizon, and the emotional stability to act rationally when everyone else is doing the opposite. Now, you might notice what I'm not doing here. I'm not giving you a single confident prediction. I'm not telling you this is definitely the bottom. I'm not telling you we're going to X price by Y date. because overconfidence is how analysts lose trust. The honest way to analyze Bitcoin is to think in probabilities, conditions, and risk management. So let's talk about risk management, because survival is the prerequisite for returns. You cannot benefit from an eventual recovery if you get forced out before it happens. The first and most important concept is position sizing. If you can't sleep, if you're checking the price constantly, if you're fantasizing about selling just to make the anxiety stop, your position is too big. Full stop. This isn't a motivational quote. It's math plus psychology. A position that is too large turns normal volatility into existential threat. It hijacks your nervous system. And once your nervous system is in control, your plan is gone. A sustainable position is one you can hold through ugly volatility without making impulsive decisions. Second, leverage is not advanced. Leverage is fragility. A 50% drawdown unlevered is painful but survivable. A 50% drawdown with 2x leverage can wipe you out. The math doesn't care about your conviction. It doesn't care how good your thesis is. It doesn't care how many times Bitcoin has recovered historically. Leverage turns volatility into a potential permanent loss. If your goal is to stay in the game long enough to benefit from the long-term adoption curve, leverage is usually the enemy of that goal. Third, maintain liquidity outside your Bitcoin position. This is the one that most people ignore until it's too late. If you might need cash for an emergency, for a business expense, for rent, for medical bills, for a life event, you need that cash somewhere safe and accessible, because the worst possible outcome is being forced to sell a volatile asset into a drawdown to cover real-world needs. Forced selling is where wealth gets destroyed. The market can stay irrational longer than you can stay liquid, and that's not just a quote. It's a real constraint. Fourth, dollar cost averaging is not theoretically optimal, but it is often practically optimal. In theory, the best strategy is to buy the bottom. In practice, almost no one does that consistently, because bottoms don't feel like bottoms. They feel like the start of something worse. Dollar cost averaging removes the emotional decision of timing. It prevents you from going all in at the top. It keeps you participating during ugly periods when expected returns may be higher. It's boring, and boring is often what works. Fifth, write down your plan. This sounds simple, but it's one of the most effective things you can do. Write down why you own Bitcoin. Write down your time horizon. Write down what would invalidate your thesis. Write down what would cause you to reduce exposure. Write down what would cause you to add exposure, if anything, because your calm, rational self needs to leave instructions for your stressed, emotional self. When you're in the middle of a drawdown, you don't need more opinions. You need a process. Now let's go deeper on the structure layer, because this is the part most retail investors never study, and it's where the informational edge lives, if you're willing to do the work. Start with supply. Bitcoin's supply schedule is fixed. Issuance declines over time, and the halving reduces new supply flow. That's the base layer of the long-term thesis, verifiable scarcity. On top of that, there's effective supply. A portion of Bitcoin is believed to be lost, coins that haven't moved for many years, keys that were thrown away, early coins never recovered. Different on-chain analytics providers estimate this differently, and you should treat any exact number with caution. But the practical takeaway is that circulating supply is likely lower than the theoretical maximum, and long-term holder behavior matters. Now combine that with demand channels. When you add major regulated products that can hold Bitcoin on behalf of investors, ETPs, funds, and institutional vehicles, you change access. When you add corporate treasuries, you change time horizon. When you add sovereign holdings, you add another category of holders with different motives and constraints. Even if each category is a minority of total supply, the marginal flow can matter a lot, because Bitcoin's liquid supply is smaller than people think. A lot of coins are held and rarely moved. That's why flows can move price aggressively. This is also why sell-offs can look violent, because the market often trades on a relatively thin layer of truly liquid supply. When that thin layer gets hit by forced selling, price can drop fast. Elevator down. And when demand returns, it can rise quickly, because there isn't infinite supply waiting at every level. Staircase up. Now, one thing I want to address directly is the way people talk about institutions like they are a single coordinated entity. They're not. You have multiple categories. You have long-term allocators who are buying as part of diversification and may hold for years. You have hedge funds that will flip risk fast and trade momentum. You have market makers who hedge options and can influence short-term flows through gamma dynamics. You have ETF investors who may be long-term, but can also redeem if sentiment shifts. You have corporates who might hold for years, but could sell if they need liquidity or if their board mandates a change. So the structural shift is not institutions will save us. That's a childish narrative. The structural shift is the market now includes larger participants with different motives, and that changes the distribution of selling and buying behavior across time. That makes the market more complex, not less. Now let's talk about indicators that matter more than price is down, therefore bad. If you want to track structure, here are categories that tend to matter. Spot volume versus derivatives volume. If the market is mostly moving on derivatives, it can be more fragile. Open interest. Rising open interest into a euphoric move can create liquidation risk. Falling open interest after a sell-off suggests deleveraging. Funding rates. Extremely positive funding means longs are crowded. Extremely negative funding means shorts are crowded. Extremes can precede reversals, but not on a predictable schedule. Options implied volatility versus realized volatility. If IV is far above realized, options traders are pricing big moves that may or may not occur. If IV collapses, it can signal reduced fear. Skew. If puts are priced much richer than calls, fear is elevated. Again, not a timing tool, but a regime indicator. On-chain exchange flows. Spikes in exchange inflows can indicate potential selling pressure. Outflows can indicate accumulation or self-custody trends. But context matters. Custodial changes can also move coins without reflecting intent to sell. Long-term holder supply. If long-term holders are distributing heavily, that can matter. If they're holding steady while price drops, that can indicate conviction. ETF flows. Steady net inflows during flat or down price can imply absorption of sell pressure. Large outflows can amplify downside. You don't need to track all of these to be a good investor, but you do need to understand that price is the last output of a system. It's not the system itself. Now let's bring this back to the human side because I want to help you actually survive this, not just understand it. The market doesn't reward suffering. It doesn't punish serenity. It just transfers assets based on behavior. If you bought Bitcoin as a long-term asset, then the only real way you lose the long-term bet, assuming the protocol thesis remains intact, is by not being able to hold through volatility. So the real question becomes, what makes you unable to hold? Usually it's one of three things. 1, your position is too large relative to your emotional and financial capacity. 2, you're using leverage or borrowed money. 3, you don't have liquidity outside the position, so life forces you to sell. Fix those 3, and you eliminate most of the catastrophic outcomes that retail experiences. Now there's one more layer to this that people don't like to admit. A lot of investors say they have a long-term horizon, but what they really mean is, I want long-term returns, but I also want short-term comfort. Bitcoin doesn't offer that trade. It never has. If you want the upside, you pay for it in volatility. That's the deal. And the market will test whether you understood the deal over and over again. That's why I keep saying this moment is about structure and behavior, not vibes. Now let's address a common misconception. If institutions are buying, why is price going down? Because markets can have net long-term accumulation and still drop if short-term selling pressure is stronger. This is especially true during deleveraging phases. Imagine a tug of war. On one side, you have steady demand, long-term allocators, periodic ETF inflows, some corporate purchases, some dip buyers. On the other side, you have forced sellers, liquidations, risk-off flows, redemptions, miners or funds that need cash, and traders hitting stops in thin liquidity. Price is the rope. If forced sellers pull harder in the short term, price drops even if the long-term demand is real. That's why you don't anchor your thesis to short-term price. You anchor it to whether the structural adoption and supply dynamics remain intact. Now, none of this is meant to hypnotize you into never sell. There are valid reasons to reduce exposure. If your personal finances change, if you realize your risk tolerance is lower than you thought, if you need liquidity, if your time horizon shortens, or if your thesis changes, reducing exposure can be rational. The point is not diamond hands as a personality. The point is, don't let short-term fear make a decision your long-term self will regret. So here's a practical framework you can use in real time when you feel panic rising. Ask yourself 3 questions. What specifically changed about Bitcoin's fundamentals? Not price, fundamentals. What specifically changed about the macro environment that invalidates my thesis? Not, it feels bad, something concrete. What specifically changed about my personal situation, income, expenses, liquidity needs, that makes this position unsustainable? If the answer is nothing changed except price, then selling is probably an emotional trade, not an analytical one. That doesn't mean you must hold. It means you should recognize what kind of decision you're making. Now let's talk about the different texture of this cycle because I want to make that claim responsibly. Every cycle has similarities: hype, leverage, drawdowns, recoveries. But this cycle has unique structural elements. Regulated access has improved through investment products. Corporate treasuries are now a visible category. Macro conditions have been unusually central. Real yields, tightening, and liquidity regimes. Market microstructure has evolved. Derivatives are deeper, options are more active, and hedging flows can influence short-term moves more than earlier cycles. And narratives are competing. AI, defense spending, energy, and other macro themes compete for capital. So when I say different, I don't mean guaranteed better. I mean, you can't analyze 2026 with a 2017 retail-only lens. Now, I want to give you one more psychological tool, because this is where people either become investors or remain gamblers. Stop measuring success by whether you feel good this week. Measure success by whether you executed your plan without self-sabotage. If your plan was to have a certain allocation, keep a liquidity buffer, avoid leverage, and DCA over time, then success is doing that even when the chart looks terrible. Because markets don't reward the person who feels the most confident. They reward the person who can stay rational when confidence is hardest. And to be clear, being rational doesn't mean being numb. It doesn't mean you don't feel stress. It means you don't let stress drive your decisions. Now, I'm going to close this with the most important practical point in the entire video, and I want you to actually hear it, not just nod along. If watching Bitcoin's volatility is causing you constant anxiety, your allocation is too high. Not because Bitcoin is bad, but because your portfolio is misaligned with your nervous system. Fix that alignment and everything gets easier. You stop doom scrolling. You stop needing the market to validate you daily. You stop looking for someone to tell you what will happen next. You start acting like an allocator, not a spectator. And that's the shift that separates people who benefit from cycles from people who get consumed by them. So where does that leave us? It leaves us in a market that has repriced sharply, flushed leverage, and is now in a battle between short-term forced flows and long-term structural accumulation. It leaves us in a macro environment where liquidity and rates still drive risk appetite. It leaves us in an adoption environment where access and participation are broader than earlier cycles, even if sentiment is ugly. It does not leave us with certainty, but it does leave us with a framework. And in markets, a good framework beats a confident prediction. If you value analysis that prioritizes logic over hype and long-term thinking over noise, stay with this channel. That's the identity I'm building here. Calm, data-aware, risk-first thinking in a space that constantly tries to pull you into emotion. Markets reward patience, not panic.